Hi there. My name is Craig Basinger, and I'm the Chief Market Strategist at Purpose Investments. And today we're going to talk about one of our recent articles called The Great Rebalance. And really, what it's talking about is a bit of a case on the international equity side of markets and the recent outperformance, whether this is just a signal or noise. And we're going to highlight a number of different reasons why we think this might be why this trend might have certainly some legs to it and certainly some portfolio implications. So let's jump to it. This is our disclaimer. I'll allow you to hit pause and read at your leisure. Uh, but listen, 2025 has certainly seen strong outperformance in international markets. TSX is up 12, S&P up 4, Europe's up 17, Japan's done decent, Hong Kong and emerging markets as well. And the question is, this is just the rolling performance over the last, call it 15 years. And as you can see, America has dominated markets. And fool me once, shame on you, but fool me 7 times, because any of these brief periods of international outperformance has quickly been followed by a rebound in the US and them regaining that top spot. So the question is, is this just noise, what we've seen so far this year on the international side relative to US, or is it a sign of things to come and a changing leadership? Now, I think it's really important when you look at international markets, these are very long cycles. So this goes back to the 1950s, and there have been extended periods where the US has outperformed international and extended periods where international has outperformed the US. And obviously, we've just come through sort of a 15-year period where the US market has dominated international. Uh, and it's also worth pointing out, like, even though there's a little blip at the end of this chart on the right-hand side here, all of that relative outperformance from international came in Q1. Since then, actually, US and international markets both have been doing extremely well since Liberation Day, but they have been pretty much lockstep. But the key takeaway here is if there is a change, this is a very long cycle. And in other words, you probably haven't missed it if there is truly a change in leadership. So, the question is, has it changed? And then also which international market, because that's key as well. Like a lot of these past periods where international markets have done well, sometimes it's just been Japan, or sometimes it's just been Europe, or sometimes it's just been emerging markets. So it's not quite as simple as just saying international is the place to be. A lot really depends on where that performance is going to come from. But the bottom line is, if the leadership has changed, these are long cycles, and you probably haven't missed the boat yet or have missed the opportunity because this is still very early. So look, we broke this down into sort of long-term secular considerations and then some short-term considerations. And we're going to talk about the long-term first. Obviously, one is those long cycles. The other is currency. So this is the US dollar versus CAD and also the US dollar versus a trade-weighted index. And, it's really hard to forecast where currencies are going to go. I'll be honest, that's really challenging in the marketplace. But we would point out that we do know that most currencies are undervalued versus the US right now. And that's very important because if you look back at, the last period where international did well, which sort of started in 2001, 2002, again, international currencies were really cheap at that point. And if you look at periods where the US has done exceptionally well for an extended period of time, very often those started when the US dollar was very cheap. So because the US dollar is expensive right now, international is cheap. That is certainly a vote for more in the column of more international versus US, or at least a better balance. The other aspect is, international is a bit of a fixer-upper. Listen, I'll be honest, America is pretty awesome. You might not agree with the current leadership, but nonetheless, and some of the policies are enacting, but America is very entrepreneurial. It is very investor-friendly. There is very easy access to capital. It is technology-led, which is obviously very important. And they are spending gangbusters on the fiscal side. Now, you can disagree with deficits and where those are going, but right now that is driving growth. Where if you look at most international markets, I mean, let's just say like they're a bit of a fixer-upper. They've got worse demographic issues. It takes much longer to start a new business. They're just not as investor friendly. And again, that's that's an important consideration. But the other aspect is, and if anybody knows real estate, those fixer-uppers and you put on a fresh coat of paint or you fix the roof, that can have a pretty material impact on the value of that house. And international markets might be that. Because what we're starting to see is a lot of international governments are starting to at least tilt a little bit more towards pro-growth policies, whether it's Canada doing a bit more on the fiscal spending side, trying to take down some of the regulatory issues in Canada, whether it's interprovincial tariffs. If you look at Germany, I mean, Germany is a prime example. They have changed their deficit policy as far as how much deficits they can run. And that has led to the DAX being one of the best performing international markets year to date. So we're not saying international markets are getting anywhere close to being as capital friendly and investor friendly as the US. But what we are saying is that on a relative basis, it does appear they're starting to close that gap. And at the same time, the US is starting to implement more and more policies that are somewhat negative, especially for international investors on margin. So if you sort of take a look at those things, that gap might be starting to narrow. This chart is, I think, fantastic. So the first bar for each country or region is their deficits before COVID. The gray bar is COVID spending. Obviously, that was in response to a pandemic. And then the blue bar is the last 12 months. And the key is here, a lot of other countries dialed down their deficits a lot more than the US did coming out of COVID. And that hurt their economic growth. And now some of them are starting to actually spend a bit more. We're not going to get into deficit spending and the longevity or the sustainability of that, but for the near term, more fiscal spending is certainly positive for growth. So, at the margin, we don't think the international markets are getting as great for investors as the US, but because of the lower valuations and where they're starting from, they're sort of a fixer-upper, and you can very often see bigger gains in that kind of environment than you can looking at the US market, which is obviously priced for all of these great attributes that it already has. The other aspect on the long-term side is everybody is over their skis on the US. And this is, listen, performance chasing happens across the board, whether it's individual investors, portfolio managers, or even indices. And the fact is, about 50% of global market cap is now US. If you look at developed markets, it's closer to 70%. So it's very tilted towards the US. And the question is that proper diversification, or is that just the remnants of performance chasing over the last 15 years? We look at individual portfolios as well quite often. So this is an amalgamation of models that we tend to that we run analysis for on an ongoing basis for advisors. And even across most Canadian portfolios, this is going to be our proxy. There is a whole pile of US. Certainly you have more in Canada, a good amount in Canada because that's sort of that home field and tax benefit and less currency risk. But again, international markets are very light across the board. And when everybody's on one side of the boat, listen, even if you don't go overweight international, getting more balanced and a more neutral allocation might be certainly a good idea. So, even if we're wrong, and maybe international market doesn't outperform the US going forward, which we think it will, even if they're actually going to be tied going forward, there is a strong argument that a strong diversification benefit of adding a bit more on that international side. And if that international actually outperforms, then, even better. Now, switching to some shorter term considerations, listen, I mean, we'll highlight valuations here. This is the PE ratio of the US versus the TSX versus Asia versus Europe. And what we're highlighting here, and this is just relative to the global PE for the overall markets. And, everybody knows the US is expensive and everybody sort of gets that, but that's not new either. So it's really hard to get excited about valuations. But we would certainly put a checkbox with valuations on the international side are still relatively compelling, especially compared to the US. But the more interesting aspect is earnings growth is changing. Like, in 2024, you could easily make an argument like, yeah, US should outperform in 2024, which it did by a significant amount. But that was also because there was better earnings growth in the US, in part thanks to that fiscal spending. But the fact is, there was lack of earnings growth everywhere else. Now, that relative earnings growth has really narrowed in 2025 and is also expected to be relatively narrow in 2026. And again, all of a sudden, that argument for, US exceptionalism starts to sort of fade if other markets are actually growing at a similar pace. So even if we're wrong, there's a diversification benefit and moving to a more neutral balance. And we would point out that the relative growth and valuations are starting to favor a bit more on the international side. And then there's a bit on the momentum. Like I said, at the very beginning, this is developed ex-US versus the S&P 500. All that outperformance came in Q1 before Liberation Day. And since then, they've relatively been tied. So one could argue, well, maybe that's it. Maybe that was the blip. Maybe that was that fading and, it's back to the US leading. The other aspect is maybe the market's giving you a second chance to sort of potentially add to international uh, with sort of markets being tied. These are just some momentum indicators, relative strength, the index versus its 50-day moving average, how far it's above, and then the performance since April. And what we would point out is even though they've been relatively tied over the last number of months, the momentum is a bit stronger in the US. And again, I think, if you are looking for a time to rebalance, certainly rebalancing when the US has decent momentum, a bit better than international, is a better time than the opposite. So again, I think if people choose to do a bit of rebalancing now and adding more international, I don't think you're chasing performance at this point, given what we've seen in the last few months. So we think there's a bit of a great rebalance that's potentially starting to take hold. Again, these are very long-term cycles on relative performance. And if that is changing, there is lots of room to run on the international side. The currency certainly favors international at this point. The bar is set pretty low, and we're starting to see more positive market and economic growth policies coming out of a lot of international markets that we didn't see in years past. And I think that's a positive that's going to gradually feed into markets. And the fact is, most portfolios are kind of over their skis on the US side. So adding a bit more international certainly is prudent, even from a diversification perspective. Again, valuations and earnings momentum certainly help. We did highlight one counter argument here. If AI does continue to drive markets, which is a distinct possibility, that certainly favors the US. It may also favor emerging markets as well. China is probably a close second on the EM side. But still, you put all of these together and it does add a lot more credence, especially given people's low relative exposure to international markets for Canadians. Maybe we should be considering a bit more on the US or on the international side. So again, we do think this does look like an opportune time to better balance portfolios ourselves in our multi-asset. We are certainly a bit more overweight on the international side and emerging market side. And if you'd like to find out exactly how we're doing that, feel free to reach out to either one of us or one of your purpose wholesaler to get more details and set up a call. So I would thank you very much for listening. And with that, we'll leave it there. We're not betting against America, but we certainly are suggesting people should be much better balanced going forward. Because if this cycle has changed, like I said, it could have a long way to go. Thanks again, and have a good day.